Hi everyone, welcome back to the channel. This video is going to be me displaying my long-awaited stock watch list. So what I'm planning to do in this video is take you through a number of the stocks on my watch list, stocks that I think are great companies and are trading below their intrinsic value. And I'm going to take you through what all of these companies do, what I like so much about them, and why I think the prices they're trading at right now represent good buying opportunities compared to what the companies are actually worth. So I'm going to be going through 5 stocks on my watch list today, and I want to be clear and say that these aren't all of the stocks on my watch list. Of course, when you look at the great companies out there like Apple, like Google, like Amazon, of course I would want to own those companies at the right price. But right now, I just think with the stock market at near all-time high valuations, those mega cap companies are going to be at a price where I can't bring myself to buy them at those valuations. I love to buy companies when I think I can get them for a steal, and I just don't think that's the case for those companies like Apple, like Amazon, and all of those. So while this list of 5 stocks is definitely not a list of all of the great companies out there, it is the list of the companies I'm watching right now that represent great companies, but also trading at a price that I think could bring you a decent return. And I think this is going to be one of the most valuable videos I've put out on my channel to date. So be sure to stick around for the whole video if you want to get the full picture on why I like these stocks so much and why I think they're trading at cheap prices. And I have to say that this isn't financial advice, and I'm not recommending you buy any of these stocks. Instead, I'm just giving my opinion on why I think they're great companies trading at reasonable prices. Always consult your own financial advisor if you are planning on buying a stock. All right, so let's get right into my stock watch list. So the first stock on my watch list is Paysign Inc. Their ticker is PAYS. And Paysign is a very interesting company with an interesting business model that I think has a lot of potential going forward. So here is the slide that I think best describes Paysign's business model. Paysign is a company that pays people for donating plasma. So whenever you've heard of people donating plasma for money, or maybe you've done it yourself, you get paid for doing that, and Paysign is one of the companies behind that. Now here is an overview of the company. The revenue has been growing very rapidly since 2016. They have no debt with a ton of cash on the balance sheet, and they are also starting to diversify their products. So now instead of just being in the plasma donation business, they're also diversifying and partnering with large pharmaceutical companies to help with their payment needs as well. Now, why I like this business so much: fast growing, high margins, profitable business with predictable recurring revenues. Plasma donation is a very high margin business. All right, the cost of getting plasma from someone is very low compared to the price that that plasma is ultimately sold for. And this is a high growth business where I don't think plasma donation is going to slow down. Instead, I think it's going to speed up. Where we see the economy where it is right now, a lot of people are going to be needing money, especially with the lack of stimulus. And so because of that, I think that's a huge tailwind behind the plasma donation business. I would not be surprised if over the next few years we see record numbers of plasma donations. Coming to take a look at some of the numbers I put on the spreadsheet. First, we put return on invested capital and return on equity. These are the two numbers I look for to get a sense of how efficient a company is. Generally, the higher the better. I like to see both of these at least 15%, and that is the case for Paysign. So this company is extremely high margin, an extremely efficient business at reinvesting its profits to keep growing every year. And you can see that from their operating cash flow growth rate. As I've said in past videos, I like to look at operating cash flow as opposed to earnings, because I think cash flow gives you a much clearer picture on how the business is actually doing compared to earnings, which can easily be manipulated and affected by a bunch of non-cash items. So operating cash flow has been growing at 40% a year over the past 5 years for this business. Now, for a sense of valuation, I put enterprise value over EBITDA, and this is the basic sense of what you can buy the business for compared to how much money you're bringing in from the business. And so even though this is a 43, which is pretty high compared to most businesses, I don't think this is actually the best way to value this stock. And even with this valuation that appears high, the 40% growth rate will more than make up for this high valuation, especially since I expect the growth to continue and maybe even increase. So for an estimated intrinsic value, these are just rough calculations that it shouldn't be considered a guarantee this is what the stock is worth and what it'll eventually get to. But right now, I think the stock is worth around $6.70, and right now it's trading at under that. It's trading at around $5.70, so that gives you a 15% discount to intrinsic value right now. So the reason I'm not buying this stock right now is because the discount isn't big enough. I like to buy stocks when they're on sale by a huge amount, like ideally 50% off or more. And so this company is currently 15% off based on my calculations. But despite that, this is still a business I would buy even at these prices, because like Warren Buffett says, it's better to buy a great business at a fair price than get a poor business at a great price. And so I think this is a classic example of buying a great company at a fair price, where you're even getting somewhat of a discount. A 15% discount in this environment is better than most other companies out there. All right, going on to stock number 2. This is Texas Pacific Land Trust. And this is a stock I actually made a video about. It was one of the earlier videos I put up on my channel, so a lot of you probably haven't seen it. I'll put a card up to it right now if you want to check out my full analysis of this stock. And so Texas Pacific Land Trust is a royalty company, and these are some of the best companies in the world because, as you'll see, extremely high growth, extremely high margins, and this company is basically a machine that just brings in passive income every single year. So this company owns thousands of acres of land in Texas in the Permian Basin, which is one of the largest, which is one of the best locations in the US and the entire world for oil drilling and production. So what this company does is they own the land and they allow oil and gas companies to come on to their land and drill for oil and gas, and in exchange Texas Pacific Land gets a royalty based on the sales of those companies. And now they've also been diversifying, so instead of focusing entirely on oil, they're now diversifying into water streams, which I think provides a big opportunity for them going into the future, especially with the potential of oil production and prices going down. They have the best balance sheet out there, especially out of any oil or gas company, a ton of cash and no debt. You're not going to find that in any other oil and gas company out there. Most oil and gas companies are leveraged up to their nose and they're on the verge of defaulting on their payments, especially now, and most of them are losing a ton of money based on the price of oil. Okay, so just to get a sense of how efficient this business is, return on invested capital over 40% for the last 10 years and an 80% EBITDA margin. Like I said, the only place you're going to find that is royalty companies, where the expenses are basically zero. They really don't have to do anything in order to make money. And so here is how fast this company's been growing: a 79% annualized free cash flow growth rate over the past 4 years. That is, you're not going to find that anywhere else. So this is one of the best performing businesses in the past 5 years. And again, we're seeing this company diversify more into the water space, which I think is a pretty good move going forward. And we saw in 2019, water services and operation made up 28% of this company's EBITDA. So this is the history of the company. This company is actually the second oldest company on the New York Stock Exchange, all the way back in 1888. So that's over 100 years ago. There was a company, Texas and Pacific Railway, and so that led to the formation of Texas Pacific Land Trust, where they were just given all this land and basically told to just manage it and find a way to make money based on managing this land. And I would argue that they've done an extremely good job of that. We can take a look at the stock price and how that's performed. And I read somewhere that this is actually one of the best performing stocks over the past 10 to 20 years, where this company's outperformed stocks like Apple, like Facebook, like Google. I think they're just behind Amazon. So I think Amazon is the only company that's generated a higher return compared to Texas Pacific Land Trust over the past 20 years. And if we take a look, let's just go back to the year 2000, we're looking at over a 6,000% return. And based on the highs last year, that got up to over 11,000%. So obviously the growth rates of this company are being reflected in the stock price going up by 1,100% in 20 years. And those growth rates are expected to continue. We see return on invested capital 91%, return on equity 45%, and their operating cash flow growth rate 50% per year. So this company has been growing by an insane amount. I have not seen growth rates near this really anywhere else in the stock market right now, and I don't expect them to slow down that much. As the price of oil is depressed, we're probably going to see a slowdown in some of these growth rates, but I still think we're going to see 30 to 40% growth rates for the next 10 years with this company. But despite that, they're trading at a low valuation. Enterprise value to EBITDA only 7 is under 8. So if you take that into account along with the growth rate, I put the intrinsic value at around $1,000 a share. And so right now the company is trading at like $460. So that brings you to a 53% discount. So this is what I'm talking about when I say I want to buy a great company at least 50% off. This company actually fits that criteria right now. And so this is one I am closely keeping my eye on. There are a few things I want to see play out before I actually pull the trigger on this stock. And they were trading as low as $300 back in March in the stock market crash. So I wish I picked up some shares there, but it is what it is. If it gets back down to that level in the near future, I will absolutely load up on this stock. And one of the things I'm specifically waiting for with this company is right now, the company is classified as a trust, not a corporation like the vast majority of other companies are out there right now. And so that brings some disadvantages and risks to the company as it is presently constructed. Right? For example, trustees are in charge of the company as opposed to a normal management team, and the trustees have more power compared to a normal corporation, where it's really these trustees really have free reign to do whatever they want with the company, manage it however they want, pay themselves whatever they want. And so even though they have done a very good job of that in the past, I still think that is a risk, having a couple people at the top holding all the power in this company. But this has the potential to change. They recently announced that the trust is going to reorganize into a corporate structure. So they're going to go from a trust to a corporation, which puts those power checks in place for the management team. And I think that takes a lot of risk out of the equation for this company. And I think it says here by the fourth quarter of 2020, this should be complete. So once this happens, I would feel a lot more comfortable about investing into the stock, because that's just one more risk that is mitigated after the trust reorganizes into a corporation. So going on to the third company on my watch list, it is Nelnet, ticker NNI. And Nelnet is a very interesting company with a very interesting story. And I think it is a stock that is currently being underappreciated by the market. So the typical narrative of Nelnet is that they're just a student loan provider, a type of company that is very out of favor with the market right now. But I think if you look beneath the surface, if you're going to find a lot more attractive story than what the company is currently made out to be. So if you look at the numbers for Nelnet, their growth rates really aren't that great, especially compared to the other companies on this list, where return on invested capital, not even 1%, return on equity 5%, and their cash flow has actually been decreasing over the past few years. So the reason I think this company is an attractive buy is not because of the student loan business, but because what else they have going on in the company right now, where they're actually transitioning away from the student loan business. And after they're done with that, we're going to see the company reveal what they really are, which I think is a high margin recurring revenue software company. So along with the student loan business, Nelnet has developed Nelnet Business Services. And what this company does is they provide payment technology for K-12 schools, higher education institutions, churches, and businesses in the United States. So this company basically developed a tuition payment platform, and it's mainly for private schools at the moment, and they're trying to break into public schools. And this is a huge opportunity in the market where they have most of the market share for private school tuition payments. And this is a classic high quality software business. And if you look at what valuations are being placed on software companies right now, once the market realizes that this is the direction Nelnet is going in, after they stop writing new student loans, their student loan business right now is in runoff. So that is going to fade away over time. And then once this takes the forefront of their business, a software-like company, I think we're going to see the valuation of this company jump up. This company also has a ton of other subsidiaries. So another part of the business is Nelnet Communication Services, which is a fiber optic network mostly operating in the Midwest, I think out of Nebraska, where this company is headquartered. And so again, just like with the software company, another great business, high margins, recurring revenue that I think will bring this company a higher multiple once it's obvious that this is the direction the company is headed in. Along with that, they're also starting to launch Nelnet Bank. So they recently got approval from the FDIC to get a bank charter, and those are very rare nowadays, where not many companies are given permission to open up a bank, but Nelnet recently did, and they're going to open up an internet-only industrial loan company and bank. So you can think of banks like Ally that operate only online, and these are very good businesses. And I think this is a huge opportunity for Nelnet to become a full online bank that will allow them to continue to grow at a very good rate. Now, what I think is the best quality of this company is not that they're a student loan company or even that they have a software business or a fiber optic business. It's actually what they do once they bring in that money. This company is actually very similar to a company like Berkshire Hathaway and Warren Buffett, where with Berkshire Hathaway, they bring in insurance float and they use that to invest in other businesses. Nelnet, on the other hand, uses their student loans to use as liquidity to invest in other businesses. So Nelnet has been investing in a ton of other businesses out there, and they are generating very good returns from this business. Just one of the names right now is HUDL, and this is a huge opportunity for this business. For anyone that doesn't know what HUDL is, they are one of the largest sports platforms for high school and college athletes. And this is a huge thing, especially in high school, where every high school athlete that wants to play in college, they're going to be posting their highlights on HUDL, and that's a platform where you're going to see players, you're also going to see scouts and coaches be on there to try to recruit players. So this is a platform that's been exploding in popularity recently. They have a 20% stake in HUDL, and if you look at the valuation that this company is currently trading at, the HUDL is currently worth $430 million, and I think that's going to go up. I think eventually HUDL will be worth $1 billion, and so 20% of the entire company is no small position. That's $43 million just based on today's valuation. Like I said, I think that's going to go up, but that is the potential of Nelnet. The management team is obviously very good at redeploying capital into other businesses to generate high returns, and I think that is going to continue. So even though with the low growth rates they have now, I think just based on a re-rating of what the company already has, a conservative estimate of their fair value is $90. That is around a 27% discount from where the company is trading at today. All right, the next company is Essent Group, ticker ESNT, and this is also a company I've talked about previously on this channel. It was probably 5 or 6 months ago at this point. So Essent Group is a mortgage lender. They provide private mortgage insurance, PMI, which is a part of mortgage lending that is growing at a very fast rate compared to the typical FHA loans. And just taking a look at this company, they have a very good credit rating where they're rated A3 by Moody's, A by AM, and BBB plus by the S&P. They also have a reinsurance business, which I think takes a lot of risk off the table since they just at the beginning of this year reinsured their insurance book. And if you look at the financial results of this company, very consistent growth, whether you're looking at the premiums earned from their insurance or their pre-tax income. And new insurance written is also consistently increasing as well, which is what you want to see with an insurance company. They only loan to some of the highest quality companies. If you look at their loans by FICO score, the vast majority of their loans are only to people with at least a 700 credit score. So that will help this company get through this time where there's most likely going to be a number of defaults in the mortgage space, no doubting that. So while there may be some short-term pain with this company, I do think they'll be able to recover and keep growing as fast as they were. Now, this is just an excerpt from one of the recent earnings calls of this company, and I think this just points to how good the management team of this company is, where the CEO says senior management's long-term incentive compensation is driven by growth in book value per share, which we believe best demonstrates value to shareholders. And he is absolutely right on that point. For insurance companies especially, what investors are really looking at is the book value of the company and how fast the book value is growing. That represents the equity, what the stockholders actually own. And so when you have a management team that is incentivized based on this metric, book value growth, I think that is a very good sign for shareholders. Where I think you should always look for a management team that has incentives as closely lined up to the investors as possible. And this is a case where management team and shareholder incentives are pretty much identical, where the management wants book value to increase so they can get their bonuses, and shareholders want book value to increase so the stock will be worth more. I think that just points to the high quality management team along with the high quality business. So right now, I think this company is worth around $60, which it was trading at a few years ago. Right now, the stock is at almost a 30% discount to that price. So again, right now, I'm not investing in them because even though they are at a pretty good discount to their estimated intrinsic value, I do see some problems in the housing market going forward. I do think we'll see a spike in defaults, which I've talked about extensively on this channel. So I think there may be some short-term pain for this company. If we ever did see a dip down to where this company would be 50% off, there I would be happy to pick some up. And for the last stock on my watch list, we're going to be talking about Sprouts Farmers Market. So they operate farmers market chains where they focus on natural, healthy foods. And so here is some of their strategy. They're really focusing on their target customer, refined brand and marketing approach, create an advantage supply chain, and goals like expanding return on invested capital and 10% unit growth. Here are the target companies where we're seeing a growing portion of the population really have a priority on healthy organic foods. And so when you're looking for those foods, this is a one-stop shop where pretty much everything in the market is healthy and organic. So there have been tailwinds in this space where we're now seeing a surge in delivery, especially from supermarkets, and this company has picked up on that trend where they're now seeing delivery spike up as a lot of people are ordering food from Sprouts and delivering it straight to their house. So I think this next slide is a great opportunity for the company where they're actually focusing on building smaller stores, right? They want to stay true to that farmer's market image, which isn't the typical, massive commercial supermarket. It's a smaller store with organic foods. And what this company says that will help them is keeping their costs down, keeping their margins up, which is a problem for many grocery chains out there, and will allow them to expand more rapidly, right? This is sort of the idea for the smaller store sizes, lower cost to build, reduce operating costs, but the sales still remain flat. So even though the stores will be slightly smaller, they still expect to sell the same amount of food. So that will result in strong returns, strong margins, and will allow them to accelerate their growth. And this company is one that's trying to expand very rapidly into a number of states now where they have 300 to 400 new stores in expansion markets. Again, a great growth opportunity for this company. So if we look at the fundamentals of this company, return on invested capital, almost 10%, return on equity, 33%, which I like a lot. Their cash flow growth rate over the past 5 years has been 14%. And despite this growth story, this has actually been a relatively unloved stock by the market. Their enterprise value to EBITDA is only at 9.52%. If we take a look at the stock price, right, during the time this company's been public, we actually see a divergence between the stock price and the fundamentals. Where we see cash flow going up for this company, earnings going up, margins increasing, and the company growing successfully. But during this time, the stock market has really done nothing but go down. And so here is where I think an opportunity comes into play, where once the investor sentiment on the stock begins to change, I think we could see the stock absolutely take off. And so just to give you an idea, I think it is very reasonable to see this company at around $63 in 3 to 5 years' time if their growth continues to go as planned, and that gives you a 66% discount just based on the current price today. So this is the most undervalued stock out of any of the stocks on my watch list. And so out of all the stocks on my watch list right now, this is the stock where I'm the closest to actually putting money into the company. I think it's a great opportunity. I'm still looking into the company a little more to make sure I really understand what their business is and what direction they want to head in over the next decade. But assuming everything checks out, this is a company I'm very likely to begin investing into over the next few months, especially if we see another dip in the stock market and the stock price falls to an even bigger discount than it is right now. All right, so that's it for this video talking about the 5 stocks on my watch list. The big takeaway I want you to get from this video is that I'm focusing on the best quality businesses, the most efficient businesses out there, the type of businesses that say for every $1 we invest in the business, we'll get 20 cents back just next year. Those are the type of businesses I want to be buying, where they're extremely efficient, the growth has been excellent and will continue, and along with that, they're trading at undervalued prices since they're unappreciated by the market, or they're in beaten down sectors, or the market doesn't really understand the potential of these companies. So again, these are the 5 stocks I'm looking at most closely on my watch list right now. I'm still going to come out with my full portfolio reveal, which are the stocks I actually do currently own. That is probably going to be the next video I put out, probably tomorrow or Friday. So hit the bell icon right now to get notified when I upload that video, because that one is going to be just as valuable as this one. I know this was a long video, so if you're still watching, thank you so much. I hope you got some value out of this video. And if you did, I kindly ask you to press the like button to help YouTube push out this video to more viewers. And if that works and this is your first time watching one of my videos, welcome to the channel, and be sure to subscribe right now, where you're going to get a ton of value in all of my videos just like this one. So that's it for now, and I'll see you next time.